Good evening, guys. This is Rahul Magan here as a Group Chief Executive Officer, Treasury Consulting. We know that we are living in a world when market is highly volatile. And we also know that the destruction which is happening in the markets. Example, as we speak, Facebook cutting around 11,000 jobs. Amazon joined, and according to the public information, Amazon is also planning approximately 10,000 jobs. God knows, tomorrow, without specifying any name, we have another big American company who would be joining the league. And every second day, one startup or second startup is cutting the jobs. But one thing which is very clear, we have to understand, we are supposed to be very vigilant all the times, is that market would be more volatile in the near term. The reasons would be the exorbitant hikes by the central banks, the rising inflation, which is a supply side constraint, not a demand side constraint, because a lot of agriculture product which used to produce in Ukraine, now it is not available. And why it is not available? Because we understand that Ukraine is passing from the state of war. And since you are passing from the state of war, henceforth this material is not available in the global market. In this scenario, trading in options would always be a difficult strategy, especially when it comes to multi-leg structures. By multi-leg structures, I mean to say straddle, strangle, seagull, butterfly spread, condor spread, and all these spreads. Because if you trade all these spreads, then one thing which is very clear, which you need to understand upfront, is that these spreads require exorbitant knowledge. Until otherwise you hold the exorbitant knowledge and you are doing this trading, it effectively means that you are inviting trouble. And unfortunately, thanks to the media, people often do such trading without knowing what the hell they are actually doing for themselves. In this eventuality, we left with only three solutions. Number one is the covered call. Number two is the buy right. And number three is the put right. I repeat, number one is the covered call. Number two is the buy right and the put right. But we need to understand that in this eventuality, we need to understand one important concept, and that is known as intrinsic value. Please remember that until you are aware, I repeat, until you are aware about the concept of intrinsic value, you cannot trade any of the three. And if you are thinking that without knowing the concept of intrinsic value, you would be able to take a position in all the three, then I have lots of wishes and blessings with you. Because if I go with the covered call, which means I already hold the long position in a relevant stock. And when I'm saying that I am holding a long position in a relevant stock, I mean to say I should be bought this at an intrinsic value. Example, Tata Consultancy Services is currently at 3,300. We all understand that Tata Consultancy Services is amongst few companies in the Tata Group who are profitable. And most importantly, away from debt. That's more important. Tata Group debt is slowly and steadily inching up. And unfortunately, in our media, no one holds the capability to come in public domain and say that this debt is inching up and what are the solutions which Tata Group is planning to offer so that we can mitigate that impact. I completely understand that this would never happen. This would never happen. If you are thinking TCS intrinsic value is 3,300, then I have best wishes for you, because according to me, TCS intrinsic value is not 3,300. Please go 6 to 7 months ago. 6 to 7 months ago, our media hyped TCS buyback in such a way that it would reach to 4,500. Right? 4,500. And millions of investors, I repeat, millions of investors bought this stock only because media hyped the buyback of TCS. They bought it, they thought that TCS would be going 4,500, and result, TCS went down to 2,800. And I'm sure that several hundreds of investors would have quit at that point of time, booked heavy losses, forget 4,500, they are quitting and losing at 2,800. Now, can I do the covered call at that point of time? No. I cannot do the covered call at that point of time, because if I would be doing the covered call, it would have a big mistake from my side. Who bought TCS at an expensive price of 3,600, example, and later on the TCS went to 2,800? They would have booked a huge losses in the TCS. Huge losses in the TCS. Now, any intelligent investor would have known who studied the balance sheet of TCS, because I understand that 99% of the investors in India, 99% investors in India do not study the balance sheet. Rather, the literacy level is at that place where very limited people study the balance sheet. They understand what the company is up to, how this company is going on, and so on and so forth. Which is an unfortunate fact, because until and otherwise the literacy level in the system would improve, these kind of idiocies would definitely continue. Guys, remember that when you do the covered call, when you do the buy right, when you do the put right, the first and foremost thing which you need to understand, your stock should be at intrinsic value. It would be better if stock is less than intrinsic value. Because remember that no one in the world can run away from intrinsic value. No one. Let's take an example of another Indian stocks called Intellect Design. I remember Intellect Design rose in the sky, and I was watching, very clearly I was watching, doing nothing. I was simply watching that it is a mid-size IT company. And mid-size IT company stock is growing like this. And couple of days ago, Intellect Design reached almost 420. Almost. And let the recession start. let the depression start and you will see where the Indian IT companies are going. It's not a question of TCS, it's a question of HCL, Intellect Design, Happiest Mind, LTI, LTS. You refer any Indian company, the situation is more or less intact. Henceforth, guys, the very important thing which we need to learn, which we need to understand is if we are buying a stock, it has to be at intrinsic value. Because if it is not at intrinsic value, we will pay the price of that. That's a very foremost point. The very important factor that contributes in this regard is the implied volatility. And if you continue to track the implied volatility of the stock, then you can make a big difference in your trading. Unfortunately, as always, majority of the investors are having zero understanding of the implied volatility. Since people have zero understanding of the implied volatility, they would never understand how the scene is going on. They continue to look at the historical volatility, and historical volatility is subject to lot of issues, lot of messes, and so on and so forth. And we really need to understand that the one thing that really matters is the implied volatility and how the movement in the implied volatility is going on. To conclude, the safest strategies in recession and depression which we are facing right now is covered call, buy right and put right. But unfortunately, before copying that strategy, please also see whether you understand intrinsic value or not. Because if without knowing the intrinsic value, without computing the intrinsic value, without knowing the implied volatility, the impact of that volatility on that stock, and you are simply doing the covered call, it will not yield any result in your portfolio. Rather, you will end up more losses and you will add up your losses. Henceforth, guys, do remember that implied volatility as well as the intrinsic value plays a very important role in your portfolio. This is what I would like to convey. This is Rahul Magan from Intrinsic Consulting Group. You knew my personal number +91 9899 242 978. You can visit our fixed income platform www.fixedincome.global. I repeat, www.fixedincome.global. Thank you very much, guys, and have a great time ahead. Before I go, we all should be congratulating Hindi media, because Hindi media made sure that Hindi media actually know how to fool the investors. Whether this is Paytm, Zomato, Policy Bazaar, Nykaa, yours, Delhi Valley, LIC, and many other stocks, media hyped them in such a beautiful way that millions and millions of investors fell into that trap. And at the end, they are simply losing. So we should be congratulating our Hindi media for doing a fabulous job for India. Thank you very much and have a great time ahead.